And we're live. Welcome to an ESG Autopsy, dissecting the world's least favorite acronym. Although it might arguably be our favorite acronym because it's led to careers for us. My name is Matt Moscardi. I'm the CEO of Free Float Analytics. I'm here with Noir Al-Sadi and David Frazier. We are going to do a live stream. It's a pseudo webinar. It's not, webinars are passe. Live streams are the thing. So we're going to do a live stream and we're going to talk about ESG. We're going to dissect it. We're going to declare it alive or dead. And we're going to go bit by bit here and discuss ratings. We're going to discuss data. We're going to discuss products. We're going to discuss headlines. But before we even do that, I'll introduce myself quickly, and then Noir and David, you can introduce yourselves quickly. As I said, I'm Matt Moscardi. I'm the CEO of Free Float Analytics. I was at MSCI for 10 years, so you have ESG ratings from MSCI. You're welcome. That was my fault, or at least partially my fault. It's also partially David's fault, though, so you'll hear from him in a second. But now I'm at Free Float Analytics, where we started a firm that analyzes directors. We actually do performance attribution for directors, and we do it across multiple types of performance. Noir, why don't you kick off the introductions, and we'll do David.
Yeah, absolutely. A pleasure to be with you, Matt and David. So I'm Noir Al-Sadi. I'm the CEO and co-founder of Q, sustainability solutions platform. Basically, it's a marketplace or a hub to connect sustainability solutions buyers and sellers. Both Free Float and Fruit Consulting are listed with us, plus another almost 300 more. I'm also the CEO of Canada Advisors, which is an ESG fintech advisory firm. And prior to that, I've held a number of positions in this space. I worked with the Canada Post Pension Plan as Senior Portfolio Manager, ESG Investing. I was Chief Impact Officer at Scope 4 Capital, a fund focused on climate investing. I was also Director of ESG Insights with NEI Investments. And my career or my focus on sustainable finance goes back to 2010. When I started as an activist investor, and that over time evolved into ESG engagement and ESG integration. And that's pretty much it. I'll pass it to David.
So basically what you're saying is you're significantly more experienced than I am at everything that you do. David, why don't you go next?
Hi, I'm David Frazier. I'm currently CEO of Fruit Consulting. We're an ESG rating specialist consulting firm. I started Fruit Consulting about a year ago while I was working, right after working at McKinsey Investments, one of Canada's largest asset managers, where I helped to start a $500 million sustainable equity fund, one of Canada's and the world's largest. Before that, and I think why I was even chosen for that role was because I worked at both MSCI ESG Ratings and Sustainalytics, the two biggest ESG raters. And that gave me a lot of tools to help companies currently from San Francisco to Riyadh, Saudi Arabia, improve their ESG ratings. I want to give a big shout out to a current client of mine in Italy that got a ratings boost from A to AA just a couple of days ago.
And
one more thing. I want to be very clear from the outset. This whole ESG thing is dead is annoying to me. I started a company while apparently it was dying. So I live in a world and reality. I realize there are many of them. But I live in one where ESG is not just not dying, it's thriving. I want to talk more about that.
All right. Hold your horses because we're going to get there. David, Noir's more experienced than I am. David is actually smarter than I am, which leaves me at the bottom of this totem pole. That's why I'm the MC. The MC is generally the stupidest person in the room. So congratulations to me. Now, to David's point. We'll get to David's point. First thing I want to do before we actually get to ESG dead or alive, is let's start with everyone's favorite thing to do with ESG, which is defining just a few terms, okay? And that once the three of us agree to these terms, then we'll move on. First of all, ratings, ESG ratings, they are a signal. They are a signal of something. Whether or not they're useful or not is not to be debated. We just want to say ratings are a byproduct of something. Someone took a bunch of data, created a rating. We can agree on that, right?
Yes.
You can do it any number of ways. You could do it well. You could do it badly. That's not the point. But so ESG ratings is a thing. Marketable investment products that use ratings or data, they're sold. They're marketed. They basically construct a portfolio that uses some mixture of stuff. It's up to whoever's making that product to both put it together and then market it. That's a separate thing from ratings themselves. The ratings aren't an investment product. It is what the asset managers are doing. So we can agree. When we talk about ESG investing, we're really just talking about a marketed portfolio of some kind that uses ESG ratings or data or a combination of or whatever. It's basically a thesis on the world. All right, so we agree to that. And then last, the foundation for all of that, which is just data. ESG data. That's very badly organized, because I don't know why someone was like, you know what, environmental data, social data, and governance data should just get lumped together. It's like, saying ESG investing is like saying I invest in the Dewey Decimal System. It's not really thing. The data is the data. You do something with the data. So we can agree. We separate these things, and the conversation will do that. We got ratings, products, and data. This is more or less the way. Everybody in agreement?
Yes.
With complete agreement, I would like to do this. I would like to announce that ESG is dead. Long live ESG. Now, I don't know if you guys want to take a moment of silence first before we get into this, but here's the way I'm structuring this conversation. And yes, I'm turning down the music because it's obnoxious. We're going to go item by item here, these three things that we just defined. And I want to do like the dumbest game on earth, dead or alive. I'm going to give you some headlines, and we're going to discuss actually what's happening. Because I think a lot of the confusion around ESG comes from, we've lived in this space for a very long time. I've been in ESG for 15 plus years, going on 20 years.
Has to be closer to 20 now. You've been saying 15 for a while.
How dare you? I look like it's been 15, even though it's been 20. Noir's been in it for arguably longer than I have, right? I'm just going to say that so I feel younger. And David is the baby in the room, but with like 10 years of experience instead. But we'll go through each of these things. We read the headlines all the time. We actually know how the sausage gets made. So I want to get to the sausage.
Matt, can I stop you for a second? Because I want to just interject about the three letters. I do think there is a logic for these letters to be together. I think E is about the physical world, about the environment. S is about the people in this world. And the G is about the mechanisms that govern our interactions with this world. And the business side obviously is outside of this in a way, but it's all about business as well. But that's why it's not saying business ESG. It's these factors that have not been historically been integrated in the investment process. But anyways, I just wanted to throw this here since we are at the definition stage. I might as well put it out here.
Well, I think that's super important. I wanted to mention that too, because the haters, I'm going to call them that, the detractors, the anti-ESG community, if you will, they usually harp on just a few terms that are already politically dicey on a good day, like DEI or gender diversity, which I guess is dicey again. Things like that. These topics and these issues are not well understood. I don't think it's a universal understanding around what exactly entails ESG, like what exactly is under the environment and social. I think Noel laid them out quite well, but I think it's important to note that we're talking about dozens of different issues that are non-financial in nature, that affect companies whether or not they measure them, and that will be important, not just in my opinion, but as a fact, moving forward. So I think we should be level with that as well.
Well, so I think there's those are true, as in they were categories of information or facets of society or the planet or whatever that were traditionally ignored, right? We can agree to that. I think the point, though, is lumping them together. It's as if we lumped everything we ignore together, right? and regardless of those things are correlated, uncorrelated, make sense together. Like, I ignore doing the dishes until the last possible second. I also ignore paying my taxes until the last possible second. Now, doing those two things, what if I did a rating on those two things, right? Like tax data and dish data. It makes no sense necessarily when put together. So the putting of the thing together is actually where we go from something of, that is maybe more scientific or maybe more measurable, maybe more data driven, into something that's more like an art. Why are we doing it this way? How is it doing this? The method by which these things are done.
Matt, I think whether if we stay in definitions, we'll stay in definitions. We'll never leave this part of it. But I can tell you what you are explaining is actually one of the issues in terms of why we're here and we're talking about the death of ESG, because we never really agreed on the definitions. I think people understand ESG in different ways, and some people say I can use only one letter, others have to use all the letters. So that's it. I think part of this autopsy is that we've actually failed as a community to agree on a definition, and I think that's why we're going back and forth. But I'll stop here because otherwise we're not going to move to headlines.
No,
Last point. I just think I think a part of its death, ESG, the term, is that it's always been a catch-all, but a very unuseful one. And then when it's challenged, ESG in general, if you just take DEI or climate and challenge it, then you're challenging ESG and all of the dozens of topics that we are referring to. So I think if we're going to actually put it to rest, it needs to be replaced with a word that is inherently flexible and all-encompassing. ESG is not necessarily there. I mean, climate E. There should be CSEG if you ask me. If you want to get really technical about it, and there's other areas that don't fit perfectly into those four either. So we need a better term that's less political, if possible, and all-encompassing.
All right, so here's where we'll start, because this is a good segue. We'll dive into this topic, and I'll push back simultaneously. And I'm going to start with this. Dead or alive, ESG ratings. Here's two headlines, and I'll give you a bit from the headlines. From the Ethical Investor, the headline is "Fed up with ESG ratings, are investors now embracing life cycle diligence?" This gets to your point, David, about just changing the term, like broadening the term, narrowing the term, dissecting the term, ignoring the acronym, embracing the acronym. Like, there is a terminology problem in that we've created so many terms, nobody knows what any of them mean. They're either too broad or too narrow. And this is from Michelle Demers, the CEO of Boundless Impact Research and Analytics. She said this in the article, quote, "ESG data was developed to provide transparency, but relying on self-reported metrics and inconsistent methodologies has made it difficult for investors to assess real risk and impact." Now, to me, she does a parse where she says ESG data. She does not say ratings, right? The methodology is the rating, the data is the data. But there's a second headline I want to read, and then we can jump into the conversation. This headline is actually a press release from Sustainalytics, and I'm only calling out Sustainalytics because they have a press release on this. Everybody does this, right? But the press release is DEI Rollbacks, impact on ESG risk ratings and broader implications for investors. And this is what they say in their press release. "Due to the relatively low weight of DEI in Sustainalytics ESG risk rating, we do not anticipate significant changes to overall ratings." And I looked, and then they outlined this. 40% of human capital management assessment from diversity-related management indicators, with the highest weight from diversity programs, which is 17%. This is where it gets to nothing burger. This is the death I would like to call dead. Because why 17%? Why those data points? What was the methodology that got you to here? Why do we think changing it from an ESG rating to a sustainability rating as a nomenclature absolves us of this problem, which is that it says nothing? I'll open it to the two of you to start.
What?
You have to decide, dead or alive. That's important. You're going to have to decide, dead or alive. We're making it binary, so it's annoying.
So exactly a question, Matt, is DEI dead in this context?
I'm talking about the idea of an ESG rating in the first place.
Okay.
Is it dead because it failed?
Okay.
It failed to capture a thing. It's arbitrary. The methodologies
Okay.
are what they are, whatever.
I mean, the data tells us it's not dead. Actually, FTSE Russell last year put a survey of 300 asset owners around the world on whether they use ESG ratings or raw ESG data, and 36% said they use raw data, 35% said they use ESG rating in the form of aggregated ESG data. And then you had 23% that used a hybrid of both. So still a third of the market is using it. Now in Europe, actually the portion of raw data is much bigger than it is in the US. So there are differences between markets, but at least the data is telling us that ESG ratings are still used. And I think there's a reason for that. It's because it simplifies the world into one neat number or score. While if you don't use that and go into the raw data and understand the causations and the correlations, and you have to do far more work than what you would do if you're just using a single number, regardless of whether that number makes sense or not. Because I worked in the finance industry, 99% of the people, in my opinion, are not the Warren Buffetts of the world. They are not just amazing investors. They just back things together, and they look for a market, and it's a supermarket, and they sell products and performance. You can always blame it on the market. So that's why this whole industry works. Whether ESG ratings are valid or not, there will still, at least so far, there is a market for them. Will continue to be a market for them.
So that almost feels like invalidly alive. David, what do you think?
I'm gonna have to agree with him in a big way. So let's first of all, who are ESG ratings for? There's a lot of confusion around this, like a whole lot. Even for corporations of massive sizes, they don't fully get, not all of them, but some of them don't fully get that ESG ratings are for investors, the big ones, institutional investors. We're talking about a tool for the use of the big money to make their decisions. And just think for a second, if you were responsible for managing big swaths of money, wouldn't these issues be of increasing importance to you? I just sat in the role of ESG director for 3 years, and I'm telling you, whether or not you're an ESG fund or not, these ESG issues, the dozens of them that we're referring to, this plethora of issues, matter a whole lot. And the big reason why they matter is because there was and still is a big gap of information around these dozens of topics that we're talking about in ESG, and that they're hard to get and they're hard to make sense of. The MSCI and Sustainalytics and the EcoVadis and S&Ps of the world have created a very easy to read signal that's in the language of these big institutional investors to help them understand and make sense of these big complex topics like toxic emissions and waste or board diversity. Most folks in funds don't know the details of this, but they can look at an ESG rating and say, okay, they're doing what they should be doing on these topics. So that's one thing. It's being used by big institutional investors because it's really important. And a lot of them are using them. So I look not just at the big money, I look at the biggest of the big money. The top 25 sustainable funds, which are, unlike a lot of people's thoughts, not just European, this is broad global funds, quite a bit in the US, which is supposed to be putting your ESG to death the quickest. 19 of 25 of them not just use ESG ratings, all of them do to some extent. They use MSCI specifically. Right? They have favorites. They have a preference for MSCI, and I saw that MSCI. I mean, Matt, you and I know quite well. They've been doing well for a long time, but in 2004, 2005, the story hasn't changed. MSCI is still doing extraordinarily well, particularly ESG research. It's still growing. So the big money is still using ESG ratings in a big way to make their decisions, and in the absence of something better, regulatory, all-encompassing, everyone uses it. It's not going away, not anytime soon.
So here's where I push back on the two of you. Because what I'm hearing, if I'm getting this right, is effectively ESG ratings are largely used because they're easy, because it's hard, it's a one neat number to sort of do something with, and it's hard to work with all the data. It's difficult to understand what the data might mean because there is a lot of it. we've all worked with it, right? The actual guts of the data. We know how many indicators there are, how I used to hand collect it. It sucked, right? And the biggest investors in the world are using it, and it's sort of repeatedly resuscitated. It's like zombie ESG ratings. We keep resuscitating it because it's simple. I think it needs to be dead. And I think it needs to be dead because it being hard is the shittiest excuse to have a single number, isn't it? Like,
but your question, Matt, was not whether it should be dead or alive. You said whether
right.
it is dead or alive.
That's
now,
right.
I agree with you. Look, the whole reason we went into the single number phenomena is because of credit ratings. Credit ratings measure a single thing,
one thing,
the probability of default. So they work. The problem with the ESG ratings, they said, let's use this methodology that is familiar to investors and use a bunch of data under it, which has a very different purpose, because actually ESG ratings don't predict default. They don't necessarily. The correlations are questionable, especially around ESG data. So I hear you, and I do agree that we need to move away from them. It should be dead, but it will zombie walk for a long time.
So, move to what exactly? Where's the solution? What are investors going to do in the meantime? Where are they going to get this data from? They're going to hire a bunch of former MSCI and Sustainalytics people to make sense of it for them? Come on. It's easy because it's hot. It's easy to do and easy to use for a reason. They are not sustainability professionals. They're not toxic emission specialists. They're not human capital development specialists. They're investment professionals. And they need something easy to integrate into their system to make sense of these very complex topics that they're never going to be masters in. So in the absence of ESG ratings, what are we gonna replace it with? A government rating? Come on.
No.
What's the solution?
That's not the suggestion. The suggestion is you do the work and you figure out what the data means, right? Like
no,
you cross-correlate.
It's not going to be done right. It's going to be all over the place. At least if they're using one rating or a few, they're getting the same signal. That's important in the investment world.
But they're not getting the same signal because the ratings are not correlated to one another. In fact, there are so many ratings providers offering so many different methodologies that nobody knows what is real. And rather than defining specifically what a methodology does, we define it in these ways that are like, we only look at material issues facing a company. Well, what's a material issue? And there's a bajillion of them, right? Like, how did you choose these 5? We don't really talk about the fact that when you and I were making sausage at MSCI, right? We went out and we didn't say, let's do some sort of survey or academic understanding of all the possible issues that get ignored and pick the top ones. You go out and you say, what things seem material and where is there any data?
Yeah. Where can we get it?
That Venn diagram is not the most material. That is what's available to measure.
Yes.
That is the most material, like where I have data. That doesn't answer the question so that we even suggested it should. So in my mind, I think I have to concede that you're both right, that the ratings get used and it'll zombie walk for a while. It's hard to say that, so I can't say it's dead, which is sad for me. But I also think that there is a way forward. I mean, we built director data. It's around people, right? There are hundreds of data points we use around it, and we give it to clients. We basically say, like, here's all the data points. Here's how we distill them up, but we don't create a rating. There's no rating. I don't say this director's A+ and that director's F. And the reason I don't say that is because the definition of a rating is you are handing a shorthand for good or bad. And good or bad is an assessment by me. My job is not, I can do an assessment. That's not a problem. But my job is not to make that assessment for an investment professional. My job is to give them the tools to make their own assessment. The way forward, in my mind, is for the ESG ratings to get deconstructed into elements where you can make an actual assessment yourself.
But that's exactly what you can do now, Matt, with technology. And I think that's the missing piece here. I mean, one of my clients, Responsible Capital, They build an AI tool that does that type of ESG analytics. Actually, you don't need 200 analysts or 300 analysts. I mean, this is all automated. You can look at thousands of companies at the same time, ask a specific set of questions, get the answers structured in a spreadsheet, correlated, so you can understand all of these things and then decide that for this subset of companies, these data points matter. They matter at this point in time. They matter in this geography, in this context. Therefore, when I build my model, I use this DCF with this data point. These are you can use tools like this today. You could not do it when this started. We're talking 15 years ago, 20 years ago. You had to go, Matt, you were saying you were, painstakingly doing this manually. Now you can do this with AI, and I think that's to answer David's question. We will go to a world where the raw data can be immediately analyzed and modeled, and non-financial data, and integrated into investment portfolios. That is possible today. I've seen it. I've advised on these solutions, and I do think that's the next phase of where this is going.
The problem with that, while I think that is going to be a good thing, is that will give you being, again, we're talking about big institution investors who don't like to hire a lot of people, that will give them dozens and dozens and dozens of different signals on dozens of different topics that they know very little about, versus an ESG rating like the ones we currently have. Again, very popular use of MSCI, like 19 of 25 of the top 25 sustainable investors use it, and the trend is similar when we dig down into our research and go into the hundreds. It's very similar. The institutional investors use not just a few. They like MSCI and Sustainalytics, like a lot of them, like 85% of them use the two. So they're using this information and they get one signal. They get A, or they get severe risk. That's a lot simpler, particularly for big funds where they have a lot of different companies and a lot of different things to look at, than playing with all of these data points. I'm telling you,
it's their job, David. It is their job to decomplex complex.
Yes,
I mean, why are we paying them an investment fee at the end of the day?
No.
This is too complex. It's too complicated. Let's just go, pay a third party to give us a rating and then, kind of stick it into some investment.
That's
That's actually, to me, that's violating your fiduciary responsibility, honestly.
In
If you
fairness,
know that the data doesn't... Sorry?
In fairness, they do that with traditional financial data. We don't often flip the conversation on its head and say, okay, well, I'm arguing that, yes, it's your job, use the raw data. But they often just say PE ratio. It's like three signals, right? Cash flow, PE ratio, and so
they're all problematic.
We're making it up as we go along everywhere, right?
So that's a fair point, and yes, that's an issue with the industry. But that's the rating doesn't solve that issue. I mean, that's the point. The point is it's not. The only thing I agree with David on is if everybody is using the ratings, then this has impact. I mean, because you know how markets operate. The data point may not mean anything, but if others think it means something, then everybody thinks it means something. So the question that Matt started with, that if ESG is dead and if ratings are dead, then they don't mean anything, and then none of this means anything to anyone.
Great. So I think that would suggest to me that the final answer here is ESG ratings, zombie alive, but alive, possibly just Bitcoin. Like we just believe it has value, and that's the end of it, right? Which brings us to the next thing, and I'm sure we'll interweave back to this. But the next piece of this is what the ratings are being used to do. So dead or alive, marketable investment products, right? Because the question, here are the headlines, right? This headline, ESG fund revenue stagnates amid greenwashing concerns and backlash. That one's an obvious one. We're seeing it everywhere. But there's also BlackRock notifies investors of changes to over 100 ESG funds. In the article, they say the names of 56 funds managing $51 billion were changed to remove sustainability-related terms after consultation with clients. The investment strategies were retained. So there's this shift because of the nomenclature issues around ESG ratings, because of the sort of marketing, what we call it, zeal, where everybody was out there saying, like, this will save your soul. Like, Tariq Fancy exists in the world because he understood that the marketing was bad, but then he went on to conflate everything in ESG might be bad, right? Like all of it sort of gets packaged up. There's a move away from, the headlines are moving away from the idea that ESG funds do anything. But I also saw this headline, and this is like the Jekyll and Hyde piece. ESG funds third best performing asset class. First of all, as if it's an asset class, but they're saying that they're performing, right? They perform well. So, marketable investment products, ESG marketable investment products, dead or alive?
I would say thematic products are very much alive, and I think that's where we're going. If we kind of building on our previous point on whether ESG ratings are zombie walking or not, I do think that the next iteration is that. We've had that actually before all of this. Here is a clean energy fund. And here is an EV fund, and here is a kind of social dimension fund, and you could potentially have impact funds. But I do believe the direction is thematic in the sense of, all right, I'm narrowing down my investment universe because I want exposure to, instead of gold, to wind turbines, instead of exposure to coal. I'd like to have exposure to solar energy. So I do think ultimately that is going to be very similar to a lot of ETF products out there that are selling, a world view, an industry view, and then it depends whether investors want to bet on it or not. So I do think absolutely you're going to have some kind of sustainability theme. The challenge is always going to be, how does that theme translate in actual investment metrics? How deep it is, how correlated, how real, how reliable is the data there to tie the companies in that, or the bonds or whatever product inside, let's say a fund or an ETF or a mutual fund, to what this entity is marketing. So I think that's where the conversation is going to go.
It's an issue of authenticity,
Yeah.
essentially.
Yeah.
If we're going to answer this question. Now, before I go into that, the removal of many ESG funds, at least by title, I think was due. There was a whole lot of greenwashing going around on this topic, and I think it was out of control. So I think the ones that removed the name did it because it wasn't authentic, and I think that's good. The second thing, regulation pushed a lot of this. So I think in the absence of the regulation and the talk of regulation around naming funds, that I think was definitely effective in Europe and talked about in Canada, I don't think in the States. That was definitely a big part of spooking the investment world to make sure that the names of their funds were matching the authenticity of their actual investment practices. So my answer to this, and back to the authenticity issue, is that it's not dead. It was refined. It was made better. All of the bad apples were removed, and not all of them, but a good number, and I think that's a good thing. So the ones that remain are ones that are likely more authentic in their approach to sustainability.
Well, it's worth here disaggregating, because even in this conversation, Noir, you're talking about effectively allocation by theme, right? Like, which is, when you really break it down, you're investing in a sector or business type, but you could be doing it for a thematic reason, like climate change is an issue. Mm-hmm. I have long-term, future beta is X, and that means I want to invest in that. But that isn't ESG products. ESG products is the amalgam of all the things, and it includes like a poison pill plus diverse boards plus exposure to solar energy, right? I would argue that is largely dead, which does bring back the first point, which is the construction of that as a product relies on the existence of a rating that basically sums up all of those things to make it simple to build that product. In a way, the ratings exist to make it simple to make an index so that you could license the index so that you could make that product that's called an ESG product. Is outside of the sort of targeted theme, the authentic sort of view of individual ESG issues, is the concept of sort of broad ESG portfolio dead?
No.
No. Wow.
Sorry.
All right. No.
Go ahead, David.
Yeah, hit it.
If you'd like answer it, I'll go after.
I'm studying these funds, And I keep mentioning them because they're selling the trend for $40 trillion of sustainability-linked funds. And my study keeps bringing me back to the same conclusion. I'm not cherry picking here. I'm like trying to find real answers about what these big institutional funds are doing. And they're not just growing. You just mentioned it. Their returns recently have been quite well, which is surprising considering the narrative in the media, et cetera, is still that it doesn't, they don't perform as well. But these funds are doing well. There have been more of them over the past even 2 years. During the Biden administration and during the Trump administration, they grew and their returns were positive. There were some challenges along the way with clean tech, but overall, pretty good. They're doing well. And when I say ESG funds, most of these are broad ESG funds labeled as such or called sustainability or something like that. So they are growing, they are doing well, and to me, that story following their data does not tell me a story that ESG funds in general are dying. They're not being removed. There's more of them, not less of them. So I'm just not following. My data doesn't tell me what the narrative is saying.
Fight him.
Yeah. So, I mean, while explaining, David, you said, well, clean energy funds are not doing well, but you start talking about a specific segment within an aggregate ESG portfolio.
Yes.
So that's really, so I do think that the issues around definitions. I mean, I do think when people talk about ESG investing, do include that, I want to invest in climate. They don't necessarily subscribe to that narrow definition that an ESG fund need to have the 3 letters, and the 3 letters are kind of somehow represented in the methodology. So if that's really the definition we're discussing, Matt, I would agree with you. I do think this approach is largely discredited. But discredited approaches do continue to exist in financial markets for a long time. So we can argue that there is no value in doing it, but people would potentially do it. And David, you may be following that closer than I am in terms of these funds. So there are funds that are doing that. But what happens over time, so performance so far, when you look historically at ESG funds, was because they were exposed to technology, because we said technology is not exposed to carbon, and these are cleaner companies. This is changing because of AI, because of all the emissions that ties to the environment. So I do think this idea that things overperform, at the end of the day, you have to look at the underlying sectors. It's the sectors that are driving their performance in a lot of these funds. And I would say that the exposure to these sectors is often incidental, because they're doing some kind of research that leads to some kind of overweighting or underweighting in a specific sector. I've done that when I was at a climate fund. I mean, I looked at the universe of climate solutions. We've looked at 50,000 companies, distilled them down to 3,000 companies, and decided to focus only on climate solutions. I'll spare you the whole methodologies, but we ended up with a heavy overweighting to industrials. So at the end of the day, we were actually running, to a large extent, an industrial fund. So when I hear a headline that, ESG funds did better, we got to understand what's the underlying sector is, and whether it's the tail of the dog that is actually, leading rather than the ESG side is leading.
Yeah, which I think is a good point, because when you look in like ETF database, right, like the second highest ESG scored fund, and let's just say that they're aggregating the weighted scores, one of the ESG ratings of the assets in it. The second one is MSCI's Finland index, so you're just exposed to Finland. The third one is ProShares Ultra Semiconductors, which is a levered fund on semiconductors. And ESG is supposed to be, like, hypothetically, long-term. And if we were I actually wonder about the institutionalization of ESG as a data set and a ratings, because, and this is a little tangential, but as soon as you make it difficult to change the rating, I read a headline about, the DEI will not affect, rollbacks will not affect Sustainalytics rating. Why not? Like, it doesn't, in my mind, it's like, is there a long-term benefit to that or not? Just like you're talking about AI, Noor, like, and the use of it. All right, well, if most of my top ESG scored funds are really just accidentally a sector, right? what are the long-term risks of that sector? If AI is going to be using tremendous amounts of power, then should we really be looking at like the 2x semiconductor as our best ESG score? Is that a future score, or is that a right now score? We're not even solving for what we're supposed to be solving for with these funds. In the same way that like target date funds actually do this arguably better, just by the simple thing of going from high equity, high volatility, better returns to more bonds and cash as it gets closer and closer to retirement date. So I would agree that the sort of segmented ESG is not dead. You're going to get segments. You'll get it. You'll get a climate fund.
Yeah.
You'll get a solar fund. You'll get a diversity fund. You'll get, which are themes of the universe. But like cable, I think the package is dead. like who's buying? If you're buying like 12 of, I have a view of the world where climate change is an issue and diversity is a long-term risk if you don't pay attention to it, and yada yada yada. But the ratings end up, I just own the technology sector that doesn't solve the issue. The thematic funds are fractured. I'm paying, basis points over basis points for multiple funds. I would argue that the market for ESG as a group is pretty much dead, and the segments are going to have, unless there's one segment like climate that dominates the rest, any of the secondary segments are going to live in this wasteland of 5 to 20 million AUM, and no one cares.
It depends.
So I mean, here's a data point that is helpful here. So Scientific Beta back in 2021 put a very interesting paper looking at ESG ratings and the underlying composition of the companies in these tied to these ratings. And they found out that 78% of the factors highlighted as ESG factors are actually quality factors. You could build a quality fund, and quality funds sometimes are hard to define, but it's really about businesses that have solid balance sheets and certain proper structures in terms of the financial aspect, the pure financial dimension. So if they are quality factors, you're basically just relabeling things. You say, oh, here's the same product. For this client, I'm going to sell them a quality fund because they are in some kind of red state and they don't want to hear about ESG issues. Tell them, here's a quality fund. And you go to Canada and you tell them, here's an ESG fund because it has all these things. It's the same fund. It's just a different label. We may change at the margin something here or there. And that's what asset managers are very good at doing. Asset managers are marketers. They're not fund managers. They're just about selling funds to whoever willing to buy them. That's why you find Bitcoin funds and whatever funds, wherever the demand is, there's somebody selling it. So I do think sometimes the intellectual part of this discussion, I think, get muddied sometimes by the financial considerations of asset managers and the whole financial industry kind of business model.
Yeah. So Matt, a couple of things. First of all, I don't think that this whole idea that ESG funds, sustainability funds at large, have been discredited. By who? What? No. At least in the world that I live in, when the money leaves, you're discredited. If the money is still there, I'm confused at who else, even intellectually, can say with any robust foundation that ESG funds, sustainability funds, the broad ones, are dead. Closely tied to that was my thought, Matt Noir, that, well, if it's not called a broad sustainability fund, if it's not called a broad ESG fund, it's going to be called a resilience fund. It's going to be called, you mentioned at the beginning, a life cycle diligence fund, whatever have you. But back to the original point, we're talking about dozens of different issues which do have something in common. There are a lot of different commonalities with these issues, ESG issues. They're largely non-financial. Even if we're talking about something financial, it's not about the dollar figure. And it's usually traditionally not been integrated into investment frameworks, right? So those issues are going to continue to be important to investors, especially because now there's actually some data around it. And it's going to be repackaged, to your point, Noir, but they're still going to exist. a lot of those funds, like you mentioned, Matt, that were taken down from the ESG list, if you will, they didn't change their methodologies. They might not have been completely, satisfied with whether or not their fund would be categorized as properly sustainable or not, and didn't want to risk that. But a lot of the methodologies remain the same. They just named it something else. The issues are not going to go anywhere. How we talk about it will change.
Well, here's the term I coined a couple of years ago. It's called FII or FII, full information investing, compared to PII, partial information investing. I do think that's directionally what ESG investing should be. It's about having a full picture, a full understanding of the financial and non-financial. So FII compared to, PII, which is partial information investing, if you're just looking at just the financial data without context, without understanding the non-financial context. So I do think if we move in that direction, we can exit the holier than thou, environmental, social, governance. This is about full information. The good, the bad, the ugly. We got to look at this to actually invest in a sensible way. Anyways, that's how I would do it as an investor.
Well, that's a good pivot. That's a good pivot to the last section. But I will say right before that, because David, something you said, you might have just triggered me. Something you
I'm
said.
good at that.
You were saying basically because people believe, effectively, right? If I'm distilling it down, because people believe it, it's going to continue to exist, right? Like it's not going away. People are still using it, right? But what triggered me about it is, and I have this problem. We talk all the time about, the average vote for a director on a board is 96% in favor. 99.8% of directors get reelected. 99.8%. And I quote this all the time. In a Pew poll from 4 years ago, 90% of Americans think the world is round. 10% of Americans think the world is flat, according to that Pew poll, which means there are more people that agree on directors than agree that the world is round. In my mind, just because you believe the thing does not necessarily make it true, useful, or anything. Now, to Noir's point earlier, it gets priced in, right? If the market believes it, the price goes up, and it doesn't matter. But I think that's a dangerous fiction to grow on, right? Like there's an entire industry that's basically predicated on the fact that we all believe that it matters, rather than finding out what actually matters, right, inside the thing. But because I am emceeing, I can say that as the last word and pivot into the next thing before David can prove me wrong. Here's the next section, and this is a faster section than the other sections. Dead or alive. ESG data. And the reason why you segued nicely, Noir, is because you talked about, FII is data. Full information is data. It encompasses not just data, but ratings too, because what I think part of what you want is you want the opinions of multiple people on an outcome alongside the data so you can figure out which of those opinions matters most. The argument would be for ESG ratings, get all of them and the data, and decide yourself which ones make the most sense so that somebody else can do it, and or whether all of them are sort of full of shit and you can do your own, because that's the work you need to do. But here are some headlines. One is SEC acting chair backs corporate ESG disclosures if material. In fact, here's the quote from the article. Acting SEC chair Mark Ueda, he's a Trump appointee from Trump 1, on Thursday said environmental, social, and governance reporting is necessary for some companies despite his opposition to broader ESG disclosure initiatives during the Biden administration. So he's a avowed anti-ESG guy, put in new guidelines for 13G filers just recently that says you can't engage around these issues or considered an activist. He is saying, well, the data, some of it is actually material, right? If it's material, it's material. Here's another one, and this is my favorite hot take. Robby Starbuck, who, if you don't know who Robby Starbuck is, he's an internet troll, vows to pursue firms doing DEI by any other name. So he credits himself, as internet trolls do, with bringing down DEI around, like for Walmart, for Budweiser, for he was probably out shooting Budweiser cans with Kid Rock. Who knows? But I won't even go into the article. What strikes me about this is Robby Starbuck he's using ESG data to do ESG analysis. He just comes to the opposite conclusion. He's basically just saying, I'm going to use the ESG data to identify those companies that are doing diversity things that I don't agree with. In using that analysis, I will pressure them to do the opposite thing. It's not any different. The data is the data, and that's what's fascinating to me, because they all say they're anti-ESG, but what they are is ESG analysts, just coming to the opposite conclusion. So ESG data, dead or alive. I think we're all going to be, this should be fast, but we can continue discussing.
Double alive and even more alive than ever.
Yeah. I don't think there's a way
I would
to
say
say
more
it.
alive than anything else that we've talked about today.
Yeah.
Because it's about the material issues. It's about what's happening on the ground. It's about what's happening to our ecosystems and our employees and our communities, like that. Those data points, right? ESG talks about all of those things, but in a catch-all way that's just too confusing for most people.
Well, I'll take it a step further, too, right? Because I didn't read the third headline I have here, which is Exxon swaps diversity for meritocracy in report to investors. And Bud Light did the same thing.
What does that mean in practice?
But that's the point, right? Define meritocracy, and now you're doing ESG. As soon as you get into a place where you're taking an undefined, unmeasured thing that people think matters, that people think is material, like meritocracy, you are getting new data points or configuring existing data points in a totally new way. That's effectively all ESG data is.
Yeah.
It's data sets that you think matter, configuring them, and figuring out whether they matter or whether you can use it, right?
So, a good example of why data is helpful is you doing analysis on two companies. They operate in the same industry. They are in a geographical, proximity to each other, but one of them has double the profit margins compared to the other one, although their financial structure has some similarities. That's where data of this nature becomes very helpful, because you want to understand, is it a cultural problem? Is it a turnover problem? Is it a productivity problem? What's driving it? And I think that's where we need to do that's what we can do actually more of today, because the problem with a lot of this data is qualitative. And we didn't have the tools before to do proper analytics on qualitative data. We're just too time-consuming. There's capacity issues in a lot of these asset managers and owners. So, which anyways gets us all the way back to ESG ratings. But if you have tools, AI tools and others, which again, I mentioned some of them, you can do that kind of qualitative analysis, and you can say, well, these two companies, they appear they're very similar, but I could see here, that there is an issue on their kind of human resources side. Could be DAI, it could be otherwise, could be the turnover rates 3 times, 4 times more. Could be dominated by one ethnicity for some reason, despite the composition of the geography where they are doesn't reflect that. It could be a lot of these things. That opens the door for you to see whether you can address that as an engager in an ESG fund, and you say, look, if you address that, we can unlock value. That's the value of all of this. It's not a judgment call. It's about you trying to make money. And if that helps you make money by rectifying that wrong, and you have a thesis that kind of fulfills that, then you do it, which is similar to what you're saying with that troll. I forgot his name.
Robby Starbuck.
Starbuck using it in that other way, which is fair. It's fine. That's the data. That's what actually every financial number we see is open to interpretation. That's why a stock is shorted, and another one, it has a long following and a short following, because we disagree on terms of what the data means and the implications on the financials, and we should always continue to disagree, because otherwise we won't have a vibrant market if we don't.
David, thoughts? Because I have thoughts about the idea of qualitative.
Thoughts on ESG data? I made my point already on it. I think it's the most alive. And it's back to my original point, really. The issue is about the politicization of the word ESG, not really, and the narrative around it, the discourse, particularly in the media, and for folks that don't fully understand what ESG is, it's relatively negative, and it doesn't fully take into account the various aspects, the dozens of different data points that we are referring to when we refer to ESG. So the data points and whatever they're referred to in the future, it doesn't matter as much. I think they are going to continue to drive investment decisions. They're going to continue to drive regulatory decisions, and increasingly potentially drive like individual decisions. The more this information's made public and known.
So to that point, I actually worry that there's a divorce happening between the discussion of ESG entirely and the data itself. The more and more people, like Desiree Fixler, Tariq Fancy, Stuart Kirk, all the very loud sort of ex-ESG air quotes to, anti-ESG people, I think have never seen a fucking data point in their lives. Like they've never collected one. They've never seen one column of data on an Excel sheet. They've never actually had to force rank a company on a factor. They've never had to determine whether something's material. What they did was they were all on the sort of product side of the house. They were all on the side of the house that buys some data, uses it to create something else, and then realized that something else that they created was not necessarily as advertised. And they walk away and they say ESG is a fraud, right? Like there's so much fraud in it. In fact, Tariq Fancy said people who do ESG were unqualified to do it, right? Like they've gone great lengths and gotten tremendous amount of media play from everywhere to discuss the sort of their ESG takedown. And every discussion of the takedown, and I've said this to reporters, I said, I will hand you a data set. I will hand you, just pick a data set. And then tell me what you think about ESG. Because the reality is no one has actually seen the data set except a few of the analysts who care. And until that data set gets into the hands of the asset managers and they start using it, will they care about the data anyway? Will they keep relying on the data the ratings because they never saw the data and they just sort of took it at face value and said, whatever, it's a rating, I'll use it, it's a number.
But by the way, that point on data sets, spot on, Matt. It's interesting you say that because when we were selecting a data provider, Canopus, our head of ESG, she just wanted MSCI. It didn't matter. She worked with MSCI before she wanted MSCI. But my advice was we should talk to different data providers, but not just talk to the salesperson. I said I want the data analyst working with the data sets to be there.
Good luck.
In the call. Mm-hmm. Because that's the person who really understands how good that is or not good. At least maybe we can ask them something, right? So that was my ask, is that they come, because to your point is if you didn't work with the data, you have no idea what you're talking about. Did you get them? I mean, no, we did not.
No, of course not. They don't want to talk to you.
Well, David, this is effectively your business model, right? You know the data, and there are companies who are calling you and saying, can you walk us through the actual data that matters here? Like what's actually happening, right? So
there's no one. There's maybe a dozen. If we expand to Sustainalytics and S&P and ISS, we're talking about maybe 200 people globally who've done what you're talking about, Matt. But that is build an ESG model at places where investors actually use it. And it's a very, very technical world. It may not sound like it, but when you're looking at things like racial diversity, I'm just using this as an example, or health and safety, and then talking about making sure that the information that you're getting is comparable from company to company, sometimes outside of industries even, and then making sure that it's information that you can collect on a consistent basis, and then doing all of the statistics that's involved on the back end to make sure that all of it makes sense. We're talking about a couple hundred people globally that have done this at big shops. So it's not as easy as most people think. And yeah, that's essentially why I started Fruit, because it's a big black box for most corporations. They're not specialists in these topics for the most part, and they need help.
Fruit Consulting. See how I teed you up there? Do you see how that works? That's like T-ball is what that is. But I do want to, and I want to end on this thought because we're coming at the hour, and we can go over because I assume no one cares. But I want to kind of end on this thought because I think that the argument to undermine the data is something that, David, you didn't say but almost alluded to in what you were just saying about like the data points that you're gathering, you have to make sure that they're there, right? And the argument against a lot of the ESG data is it's unaudited, it's voluntary. In fact, one of the headlines, like the Michel Demers quote, is that relying on self-reported metrics makes it difficult for investors to assess. So, and Noir, you mentioned, you sort of mentioned the qualitative aspect of this data. I actually want to look at, and I do this all the time, and I've done this in meetings with portfolio managers, heads of research, all the major firms. Flip that over. What data in traditional finance do you actually know works? 25% of companies in 2009 restated their financials after the financial crisis. Exactly when you want to trust their financials is when they restated their financials. We know that earnings management is a real thing. They actually massage earnings releases on a quarterly basis to basically align with what the overall analyst consensus is, so that they can look a company can look a certain way. We also know that when you look at a balance sheet, we're sort of functionally fixated on what's there as what's true. But a balance sheet, when you actually look at the history of a balance sheet and the history of these markets, you realize, well, actually, these items were ported over because railroads in the 1890s were the largest sector, and they created them in order to keep track of it. Some of the balance sheet items come from slave holdings. They literally wanted to account for the enslaved people.
Accounting in general came from slavery.
Accounting is a long and arduous, winding process. And we take for granted, like, CAPM and GAP and IFRS and all these theories and, buckets that we put things in. But the reality is this data, and this will be the question I sort of end on before we wrap, is this data, ESG data, any more or less fickle? Is it less useful? Is it more fickle? Should we trust it less just because it didn't go through what we're functionally fixated on in a traditional balance sheet?
So I think this question can be addressed in two ways, Matt. First, we have to differentiate between something that is quantifiable and how do you process that quantified data post-collection. So the problem with accounting is they may quantify a liability, but then they have to make a judgment call in terms of short-term, long-term, likelihood of default. The issue with some data points around ESG, it could be very hard to quantify. For example, look at a metric like employee engagement. I mean, what is employee engagement? I mean, they're happy, they're diverse, they're well paid. I mean, what number do you really put around that? How do you quantify it? I mean, you look at the kind of proxies, you look at turnover rate, you look at average pay levels, you look at diversity metrics, but you never really measure it directly because it's unless you survey them every day. How are you feeling today? Are you engaged? So that's to me what I mean by qualitative. But in terms of methodology, I agree with you. The financial world is littered with disagreement around how to value things, how to divide things, how to, how the interpretations do differ. And again, that's why stock prices jump around, because people don't have the same interpretations when it comes to the number as well, and they don't have the same level of confidence as well.
David, unless you've got anything to add, we can wrap here. Although I do want to sort of say this anecdote because I just think it's funny. My neighbor was an accountant, one of the head accountant kind of types at Comcast. And he told me a story about how they, at one of their Comcast branches, they were going to make a new parking lot. And they did not know whether to categorize it as a capital expenditure or a capital improvement or an ongoing expense, as maintenance, effectively. And it went all the way to the head of accounting for all of Comcast, and they decided, and this is what he told me, they decided that if you dig more than 6 inches into the ground, it's a capital improvement. If you dig less, then it's ongoing maintenance. And I said, why 6 inches? And he said, that's what he said.
That's your 17% on DAI, Matt.
And that, to me, is the same thing. That's the same thing. It's like we hold this data to a different standard, but this data is very, very alive. So, all right, wrapping up to end this, and it turns out there were some viewers. So thank you, viewers, who watched. To end this, dead or alive, ESG ratings. We came to the conclusion it's zombie alive, but maybe it shouldn't be. Maybe it's time that somebody shoot the ESG ratings in their current form. Now, David kind of disagrees because his
That was
business
not
model,
unanimous. Right.
his
Yeah.
business model is dependent on the fact that ESG ratings
You didn't have to say
continue
that part.
to exist. But
I don't think you can shoot zombies, man. I think you should cut their head or
oh,
something.
okay.
I'm not sure.
I don't actually know. It's like steak too hard. And I gotta watch more zombie movies. I think you light them on fire too.
Yeah, stuff like that.
Dead or alive marketable ESG marketable investment products. We basically said they've been dissected. So they're parts, like little parts of it. They're like worms. Like you cut off a big part of it, and the butt is now alive somewhere and growing again, but the other part might be dying off. So it's sort of a dissected market. And then finally, dead or alive ESG data, very, very alive. And we have more tools to deal with ESG data than ever before. Did I more or less get the consensus being there's only 3 of us and consensus is at least 2?
The middle one, that was not unanimous either. I said that there are examples of large funds that are broad-based sustainability.
You're
that
not wrong.
exist.
You're not wrong. Yeah.
I think your summary is spot on, Matt. And since we're getting to the end of this, I think you've done a wonderful job emceeing this.
Thank you.
So thank you for that.
We do a lot of podcasts. It's turns out it's not that hard. So everyone, go get a microphone. You can be cool like us. That's all we've got for this. That is ESG Autopsy, dissecting the world's least favorite acronym. Thank you, David Noir. I'm Matt Moscardi. If you want to reach out to us, find us on LinkedIn. We're going to be putting this on LinkedIn in totality. I'll put it up on YouTube, on Free Float Media's YouTube site. So just search for Free Float Media. We'll put it there. And each
Also
of us,
Fruit's YouTube.
the Fruit has its own, Fruit Consulting. So you can find us in a variety of places. Thanks for joining us, boys. We'll talk again soon.
Thanks,
Bye.
everyone.